YouTube check 1 2. YouTube check. Audio check 1 2. Uh, let's see. YouTube is now live. YouTube is good. Let me approach the bench. Okay, team. Do we have audio? Do we have video? And if you are experiencing any issues, please go ahead and refer to the link. Sup, Devil Dog? What's up, buddy? Provided above. Sup, Torito? And that'll get you over to the YouTube side, so you can to the YouTube side, so that you can watch there. Yeah, buddy. Hold on, honey. Oh yeah, good job, bud. Okay, let's get it done. Okay, team. So welcome back, master students, to the Scalpers Market week number 3. This is going to be the final, I guess, public showing, right, of the lectures for. Well, this is a week 3 of 14 weeks of the Scalpers Market, guys. And yeah, the rub it in. And yeah, team, this is going to be the final one. I hope you guys do enjoy this. We're going to go over, yes, it's called the Scalpers Market, team, because there are scalp opportunities on this, like always presented, right? In the daily trades. This does kind of trail into the trail into the momentum trade and to the day trade as well. I only say day trade because anything that's considered, opened during the part of the intraday session, right? So anything at my time, 6:30 a.m. Pacific, 9:30 a.m. Eastern, and then specifically at 1 p.m. Pacific, the close, and 4 p.m. Eastern, that within that section there is your day trade. Anything after that, any positions held after that, of course, is going to be considered a swing play or a swing trade. Anything after that. So I find that we have the ability to identify certain different types of trades and different characteristics that may fit better onto individual participants, right, or students in this case. So are you better at scalping, which could be something that could be just a few minutes long? Momentum trading, I feel that it can be held a little bit longer than your scalp, very similarly to it, except for a little bit of a longer range. And then your day trades, of course, we can just hold those for several hours. Several hours, given that you have the available space within 6.5, right, of your trading traditional day. Now, I hope that at this point, right, because we're talking about a little bit more of an advanced trader here. And if it's not obvious, right, then we're going to go ahead and make sure that it is obvious to you. I hope that it is of the obvious nature that the scalper, although it's recommended for a green trader, for the beginner trader, it doesn't mean that it's only for a beginner. Me personally, guys, I know tons of professional traders who still stay within the scalping criteria, and it's not because they didn't get past kindergarten. It's not that. It's that it's its own strategy. It's got its own criteria. It has its own persona. The type of trader that you are should fit the strategy or the strategy or the touch, right? It should fit the niche that you want to fit in. It's whatever you're comfortable with. It doesn't matter, right, guys? Oh, and hold on, team. I am noticing here that some people were not getting the alerts. Here we go. Let me just make sure that another student's here. Torito, I think I just understood right now. I'm sorry, I was so delayed. Are you talking about coin? Oh no, dude, that play was kind of ridiculous, dude, and it's not done. We're gonna catch it, man. We're really gonna catch it. Now, Stu is saying, man, Stu killed it too. I found that certain styles of trading fit my psychology better than others. Yeah, that's literally what I hope, for you guys to get. And yeah, team. You know what? It's let's see. I've been in dude. I was just mad I couldn't get more share. Oh, that's what you right. You messaged me, dude. We're not done, brother. This is a huge play. This is a really big play. It's just I don't like to. I personally don't. I mean, unless you're having a shares play, like entering at that point, you know, something meaningful would be anywhere above 150 shares, 200 shares plus would be, a pretty good, okay. Like I mean, it would have been a great return too at $30, right? But yeah, experiencing like a 31 to 33 point move on this kind of play, shares are also welcome. But I understand you. I get you. And actually, I really like that you guys are saying this, team. Thank you. I hoped that you guys would share some of this. So, Mr. T is saying my trading style is not taking profits. We're working on it though. It's not taking profits per se. Okay. Yeah. What I do, guys, please remember that what I do is a little bit different. And earlier today, I did mention that I thought somebody was going to call me out on it, but no one really did, and I think you understand maybe why. Um, did this thing? Man, come on. Yeah, guys, did you see smoke screen in here? Like somebody just asked. Let's see. Smoke screen was in here, and you guys didn't catch Lucky, right? Devil Dog, you're in here? Okay. I hate that these notifications are not going to everyone, guys. Have you guys experienced to where you're not receiving alerts to when I say at everyone? Mr. T, you never get it? You may have to set your alerts, brother. Oh, you never not get them. You always get them. So you could also adjust your alerts so you can receive alerts from only one channel or whatever. You can shut them all off and have one or several, right? You always get the alerts. But this time you didn't. See what I mean, guys? Like it's Discord is really like a serious developmental's mind type of platform. The like super smart guys on like high on weed. You know what I mean? And yeah, it's just it's not the most, it's not the easiest user friendly UI. It's a little complicated and very convoluted. Maybe I don't think it would do the best for somebody who's got some type of autism or something. This is a or maybe it would be better for someone with autism. And it just you know what I mean? Okay, I'm about to get the complaint. Hold on, guys. Good deal. Uh, okay, so okay, perfect. Now, Mr. T saying, yeah, I had to get my younger brother to show me how to use it at first. I couldn't understand. how to join chat. Yeah, where you click into it. And it was just a mess. And now Devil Dog saying I had 727 shares of coin on the rip up today, holding 121. Bro, that is the way to go. Guys, man, that kind of answer really does it does please me, because in options contracts, okay, team, remember, in options contracts, it's specifically difficult for us to hold, right? It's difficult for us to hold because the problem with that team is that theta, and then also your implied volatility will drop. There are certain metrics in options contracts, right? Certain metrics in options contracts that literally will kill you, the value of your contract, the moment that volatility stops, right? So, you know what? Let me pull up this chart. This is going to be the best way to show you. It's kind of like just a side note from the lecture. Yeah, that's a pretty good thing that you're saying there. You know, yeah, Torito, I'm going to get to that too. So what Devil Dog just said was that sometimes he could make as much money as you guys. He goes, sometimes I could make as much money as you guys, right? With options. Now he's saying that because the value of an options of a share is a 1-for-1. So once you buy one share, and the value of the share, or the price, right? The underlying price, you know, say it's $100 per share, and it goes to 101, and you have one share. Well, you've gained $1, and then it goes up another dollar, and you've gained $2. So those $2 pertain to that one share. Well, say if you had two shares, right? So that would be $2 per. It would be $2 per every incremental dollar that you get. So 101 would be $2. 102 would be $4, and so on. So if you had 100 shares, $1 would be $100. So here is where people get a little confused, and not really confused. It's just they you know, when you're playing only shares, you are used to entering a certain amount of money in order for you to see a certain amount of return, or feel the rate of change, right? Rate of change, meaning that it does have frequency, meaning that the frequency could be slower or faster based on how much money you put in as risk. So sizing. Should you size in heavy on shares, meaning that you are probably going to have to do, like, for example, in this situation, $150, $130 a share, we're probably going to have to do something around 400 or 500 shares to feel that rate of change really come in a meaningful way. So that puts you levered heavy, right? So if you feel that it's levered heavy, it probably isn't in the shares. Can we stop? In the shares perspective. So then when you jump into the options world, you're thinking here that, you know what, maybe, like, okay, I'm going to get the options, right? And you lever yourself in a similar manner that you do in shares into options. That is incorrect. That is incorrect. We need to size down, because or 700 shares in this case, right? Devil Dog was saying, thank you, buddy. Sorry for miscalculating there. So in order for him to find that meaningful rip, right, to feel the same type of volatility change or rate of change, like I said, or expected value that you can get from an options contract, the EV, you would need to lever. You would need to come in heavy, right? The problem is that you have to understand how to manage the way an options contract, I know, baby. I gotta continue in class. Okay, hold on. Yeah, you have to walk sideways. Remember. Okay, so yeah, let's see. You have to. Yeah, he's saying I have to go ham. Yeah, that's right. So if here's the thing, right? So when people go into the options contract, they lever in like the same way as that you would into the shares. The thing is that when you calculate the way that an options contract makes its money or loses its money, right? That there are many, how can I call them? Multipliers, the components. There are several multipliers in an options contract. So your options contract has the first one, which is delta, right? So delta tells you how much money you can make for every dollar increment that the options contract goes up or down, right? So when you make that $1 on that options contract, delta tells you that it'll probably tell you, delta tells you that it'll be like a 30 or a 40, let's just say 40 cents. It'll say delta 40, 0.40. What that means is that for every dollar that you change in value with the underlying, you get 30 cents times 100 shares, because an options contract has 100 shares embedded within the contract. So you get 30 cents times 100 shares for every dollar that you change up or down. So you're getting $30 or $40, right? You said 40 cents. So we said 40 cents for every dollar. Your delta is giving you that for every dollar you go up. So now you're not talking about a 1-for-1 on a share, are you? We are now talking about $40 for $1 every move, right? Is that, yeah, it could be like a 30x leverage. It could be a 40, right? 40 cents. Because it is 40 times 100, but hold on. Right next to your delta, there's a value called gamma. Now, the gamma is calculated a little differently. It's hard to really nail it, but think of it as your bonus to the delta. So the gamma is going to give you, let's just say 20 cents, right? It's similar to delta. It'll give you 20 cents at the rate of change for that dollar increment that you increase. So it can move up or it can move down, right? It's sensitive. So that means that now you're adding like 20 cents, right? Yeah, it is the kicker on delta. It really is. It's like a bonus to it. It really jams it. And then when you hold on. Now we're talking 60 cents, right? Okay. So then you have another multiplier. It's called Vega. Now Vega gives you a lesser value. Let's just say that Vega gives you 5 cents for every BIP or percentage that your implied volatility changes. So if you're at 50 IV and this thing goes to 51 IV, then you're getting $5, right? Because of 5 cents times 100 shares, you get $5, right? So now we're talking about 65 cents. But the thing is that volatility changes a lot different than you going up $1. Say this thing squoze and you really went up. Your 50 is going to go 50, 55, 58, 60, and it's going to go 68, then it's going to go 80, 90. It'll hit 100, and it'll be 150, 200, 400. So then your IV is crushing the puts. Say, for example, we were on calls. So you would be IV crushing, implied volatility crushing the puts in exchange for the volatility upside that you're getting at that moment. So then you say that you wanted a 150 strike from $140, right? And this thing goes to 160 and you jump in the money. So you're betting that from $140 where you are, you're going to buy a strike that's 160. When you jump past that 160, you start to experience something called a gamma ramp. So then your gamma value starts to increase at a faster rate, thus giving your delta further juice and making your delta increase in turn, while your implied volatility is going nuts to the upside. So now we're talking about not 70 cents or 65 cents for every dollar increment. You're now talking about 100 and let's see. It would be $1.80 to $2 as the value goes up. $2.85, $285 for every dollar you go up per contract. Yes, honey. Hold on, guys. Okay, team. Okay. Now, can I know that this is a lot to take in, right? But I'm talking about surface knowledge here. Can I get a few A's in the chat if you're understanding how the multipliers kind of work? Let me know. Let me know in the chat, guys. Please tell me. Yeah, guys, the little guy is just sick and he needs all that, but he needs to chill. Yeah. So my question is, are you understanding how the dynamics and the multipliers of options contracts work together in order for us to kind of make that money the way that I was Yeah, Coots, I feel you, right? So do we understand how the dynamics work, right? The multipliers, the components, like individually, and then how they kind of, lapse into each other or overlap into each other and continue, you know, appreciating the options contract. Are we okay with that, team? And okay, if you don't understand it, press a B. Okay. Yeah, wrong time to introduce a new little robot video game. Extremely inconvenient time to introduce a new robot game, but also when you're sick and really bored, man, keep it going, buddy. Keep it going, dude. And like to the point where frustration happens, and he just doesn't move until you'll be like, "Daddy, daddy, daddy, daddy." Yeah, like for example, Astrobot, and I just got him biped. He loves little real technical things. He's just like me, man. So anyway, team, so here we go. Let me try to do this right here in this fashion. Hold on. I'm gonna go to, let's see. Hang on. Let's see. Okay, I think I'm gonna be able to do, oh, yeah. Yeah, I'm gonna grab, I'm gonna do it by image. Oh, Guardian. No way in hell am I letting him do that. He's asked me so many times and I'm like, no. Remember, dude, that one of our members here, she was trying to help me locate someone who was trying to get at her daughter. 6-year-old daughter, bro. No thanks. Okay, perfect. I think I got one here. I think this is going to be the image for us. Yes, honey. You got to slide. Go ahead. Try it. You got to try it. Remember, I'm in class. Try it. I'm in class. You don't have to be. It's just a game. Okay. You're going to have to try something else, honey. I got to be in class. Slide, baby. Okay, here is the image. Okay. Thanks, guys. So here we go. Let's go ahead and take a look at this. Okay. So this is where you're going to experience something called the Greeks. Right? This is your delta, your gamma, your theta, and vega. When you purchase an options contract, right? These are the metrics, these are the multipliers that help your options contract value or increase in value and decrease in value the way that it is set out to be down here. So your delta in this case is telling you in this sample here, right? It's telling you that you're getting around 51 cents per share. Now, when I say per share, that means that you have inside of an options contract, there are 100 shares. Every options contract has that. So you have 51 cents times 100. So that gives you 51 bucks, right? Your gamma in this case is giving you around $2 because it's just around 2 cents, right? So 2 cents per share, you got $2. Okay. Now, in this case, this is your Vega metric. So your Vega is giving you a massive around 33 cents for every percentage that your implied volatility changes up or down. Hold on. This one is based on implied volatility changing up or down, right? By percentage basis. So if you're at 100%, right, and it moves to 101%, you get 33 bucks. 102%, another 33 bucks. 103%, another, and so on. Similarly to the Vega, similarly to the Vega metric, you have Delta. Delta gives you 51 cents, but not per percentage. The 51 cents is given to you for every dollar increment that you change. So if you go from 100 bucks to $101, $51 for one contract. So if you go from 101 to 102, $51 again. Now, if you had two contracts, right, you'd be getting $102 for every dollar. Okay, now your gamma. This fluctuates a lot. This changes. It values the increase to delta based on the rate of change. So just know that this will absolutely add value to your delta. It's like a boost. It gives it fuel. Just to give it to you in a simple sense. Before I continue, can I get an A in the chat if you guys are understanding how the dynamics work for pricing in or upside value so far? Are you guys understanding that? Please let me know. Throw an A in the chat if you are. Okay, team. So that's about how it is priced. So I'm happy that you guys are understanding that. Now, I'm just going to extend this just a little bit more, right? Because this isn't really an options class where we're trying to understand how to scalp, right? So let's go back to this right over here. And now, finally, theta. Now, theta is time decay. So as your options contract ages, you lose value. So say, for example, that you picked up an options contract that was going to expire at the end of the week. And you, at the end of the week, are having what, 4 or 5 days, right? The theta is telling you how much value you're losing per day of holding it, right? So you're losing around 6 cents times 100 shares for holding it. Now, here's the problem with this. This exponentially grows as time decreases. So it will continue to grow crazy. So as you approach the 0 day to the expiry, this will be a very, very high number. And the number is so high that it stops affecting the per day hold. It starts affecting your real time holding. So as you go through the hours and minutes of the last day, this becomes so heavy that not even your delta or gamma are able to save it. The only way to save that from, being completely destroyed and worth nothing is that if there was a parabolic move to an upside or downside, depending on if you're holding calls or puts, right? If there was really a parabolic move to overachieve whatever theta is doing to your options contract. So it's also based on rate. So time decay, it's got to be massive. It's got to be massive to move. So your time decay via theta is increasing in value or decreasing. So you're losing more as you hold more. My trick to this, guys, is that if you were to choose something that you only want to trade for maybe a few days, your expiry shouldn't be same week. I would do a bi-weekly if you want to do something that's around 3 or 4 days hold. Now the bi-weekly, why? Because if you have risk that maybe you think there's going to be a pop in the Monday or whatever, then you have enough time for that. And you don't want to hold it past Tuesday, max Wednesday. Because there your theta starts to really eat up your value. Right? The best time to let go on short term, guys, is 2 days, 3 days best prior to your expiry. Never marry your expiry. Never marry the strike. Never marry the expiry or the strike. You don't have to hold it all the way to the expiry. You don't have to hold it all the way to the strike. The strike being that if you're trading at $150 per share at the moment and you want a cheaper contract, so you're going to say that I'm going to go towards the 180s. So you're going to get a strike of 180, betting that from 150 where you're at, we're going for 180. You're growing value. It's increasing in value from the 150 to the 180. So you can pull your money out before it gets to the 180. What I told you about running in the money is like if you're trading at 150 and this thing goes to 180 and passes 180, you just went from out of the money to at the money at 180 and then in the money. Now from 180 and beyond, you're within intrinsic value. When you jump from out of the money into in the money and really convert your extrinsic, which is the distance from the present price to the strike and the distance of time to the expiry, that extrinsic value is highly valuable when it turns in the money, when it converts in the money. Then you're really multiplying big time. But you have to be right. And you can't hold it beyond it. Because when you hold beyond in the money, it'll be around $2 to $3 around there, $4 maybe, till you start experiencing a gamma ramp and your IV pump. So the implied volatility pump comes in really when you start jumping into massive gamma value. When you're above your strike price. So if you have enough time and if you have enough validation for continuation on the direction that you're betting your options contract, it'll be absolutely valuable to you. Extremely valuable. Because as you run in the money, at that moment, your theta starts to lose less. Because that options contract becomes hugely valuable. You start increasing heavy amounts of delta, hence what's happening here as you jump from out of the money in the money, right? You go from 51 cents to 61 cents, 70 cents, 77 cents as the increments go up. So this is absolutely insane. right? This is an incredible thing that happens within your options trading. But know that you're moving big time. Look at how much this one's worth down here. You see how this is now like the spread is $2.66 to $2.71. That's what you can sell it for. So if you're on calls, you're trying to sell at the ask, right? Look what happens magically into the next one as the options start to run in the money. 271 becomes $4. That's $400 per contract. $400 as it jumps further in the money becomes $570 per contract. 570 becomes $790, just about $800. Look at the $800 to almost $1,100 per contract, and look at this. See that? Now, if you were right, you picked up these contracts for 80 cents or 70 cents. So you picked them up for $70. And then if you run heavily in the money, now you're selling those $70 contracts that you got, like 30 of them. Now you're selling them for $2,600 each. Can you imagine what that feels like? For those of you who took the trade with me, on the coin ticker, let's go. Let me just answer one question here, guys. Let's see. Hold on just a sec. Hey, Devil. Hey, buddy. So it says, so when I see people saying buy Meta a year or two out, so a call option for $740 strike, that's gotta make a big move because it's so far. Yes. Leaps. Those are called leaps. As long as it is 12 months out, you're talking about a leap. So the value is extremely extrinsic. So that means that you're purchasing a massive extrinsic value, right? Which is the way, I mean, as you hold it, you're experiencing that extrinsic the whole time. It knows that it is. So as it approaches closer and closer, people start to pick them up more and more. Volume will increase. So then as you go, it's bigger probability to pick up your 6 month, right? Your 3 month. It's bigger probability to pick up your buy month. So as all these people buy this, right? And this thing costs you like, let's just say it costs you like $1,000. Your extrinsic value is valuing this contract into bigger and bigger and bigger and bigger numbers. So by the time you reach your month out, your bi-weekly out, that thing is going to parabolically explode by that time. But you have to have the patience to hold a leap. It is an extremely profitable strategy. Absolutely 100% it is. Yeah, dude, that's the whole thing, because you already know that that it's going to pass 740. You have like an 880 price target. In a year from now, you're going to go in the money that whole way. You're going to get gamma squeezed the entire way. Your delta is going to jump through the roof, gamma through the roof. Implied volatility is going to continue to increase because as you get closer to the expiry, people pick that up. The people are, we're volatility junkies, as traders. So yeah, bro. Oh yeah. You hold it. You hold that boy. Because if it continues to go and it continues to go and it continues to go, imagine this. Now imagine this. You bought it at a 740 strike, right? Imagine Meta goes to $2,000 per share. Now you have the opportunity to exercise your shares, the 100 at $740 each share. And then you could sell them for $2,000 a share each. You have the right to exercise those shares at the strike value that you purchased it at. So imagine that you bought it in the money and you said that I'm going to hold this for a year out and I'm going to buy the 200 strikes. And this thing goes to $2,000. You have the right to exercise 100 shares of one contract at $200 each. And now you have price at real time. You're up that much. $2,000 per share is what you own. People do that because they sell and collect for premium. So it takes a long time for you to be able to collect all your shares like this, right? It takes a bit of money for you to be able to invest and keep your options contracts on long term, which is why hedge funds and institutions use something called your ISDAs, right? ISDAs. They allow you to trade long-term contracts, 10-year out, 15-year out. Big promise. Big promise. So imagine people who imagine the institutions that bought $10 per share NVIDIA, and they reached the 10-year mark when the 10-year mark or the 20-year mark or whatever it did, when it went to $1,500. Imagine that. They are creating the market. It's up to us to become clever. It's up to us to think like the institutions and like big money and take it over. It's time for us to not be just a typical trader, right? But like I said, guys, this is not an options class, but I am going to continue here, okay? Let's get back into the chart. And what I was asking here, guys, actually right before I get into the chart, who can I get a show of hands if anybody ended up playing the 150 strikes or the 155 strikes for coin with me, even though they were month outs? Throw an A in the chat if you actually did, team. Let me know. Oh, right. Sorry, guys. Even the 160s or the 155s or 150s. Let me know if you played those 160s, guys. Somebody, of course, they're not here at this exact moment. Somebody sent me a text, super excited, saying, "Thank you so much, ARCa. This was amazing." They put almost $3,000 down and cashed out $7,000 in this. Team, man, that sucks. Here we go. Check 1, 2, check 2, check 3. Yup. Check, check, check. Check, check, check 2, check 3. Yup. Check 1, 2. Check 1, check 2. Okay, good job, guys. Thank you. Check 1, check 2. Let's go ahead and make sure that YouTube is going. YouTube is straight. Okay, nice. Perfect, guys. Thank you. Okay. So that was an example, right? Going in just about 3K and coming back out of that trade with just about $7,000. That's not how much risk you put for your shares to bring you back that kind of money. So if we're looking at this here, let's go ahead and look at the 5-minute. And let's say you took the trade, right? The trade that I, 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 I told you about, the whole regression and tree again, right? within the areas of this 149 to 146 for the new day, for the people who wanted to catch up. The play to enter here at 146, reaching this target here of $164. That was already close to 200% or more, because it was really fast. Right? Now, here's this. Do you see what volatility does when it reaches this resistance? Look at this. Volatility just completely cascades. It just ate crap. You see this? So when you're in this process here at the 164, the moment you reach the 164, which was the first target to do, right? The moment you reach it, that's your max volatility. Why would that be the case? And why would ARCa say take profit there? Because of IV. Implied volatility. The valuation of your options contract is completely a slave to your implied volatility increase. This is linear volatility showing me how it's moving in real time, right? This is the ARCa Bulls trading the volatility heat map. So as we reach this area here, we're at max volatility, but then as it stays within this area hovering, you're thinking to yourself, should I hold, should I hold, should I hold? But look what happens to the options contract. Remember what I was telling you, that you can actually lose value if your implied volatility drops, right? So it doesn't matter that you're staying up here. You're losing money by staying there. See that? Your implied volatility drops like crazy. So even though you're up there, the percentage basis that you had increasing by whatever rate that Vega was telling you, you're dropping. So now imagine that you increase the upside, right, in price, but then you're experiencing volatility dropping as you increase in price. You're also losing money. How crap is that, right? So Torito's saying, so as volatility is at max, there was nowhere for it to go but down. No, the volatility here is unfortunately capped at a 100% read. This is only an average of typically when people tend to risk off, right? But typically when people tend to risk off is also at what time for the execution students, right? See the time? That's your 6-hour close, SPX. Not only the 6-hour. Phantom time 1, 2, and 3 hours close. So you have a confluent 1, 2, 3, and 6-hour close there on the major index, which means people risk off. So your max volatility is within that hour and a half. And then your power hour, right? The thing is that this is only restricted to the 100%, and you're maxed out at 100%, right? Now, that doesn't mean that actual volatility, implied volatility, doesn't increase beyond 100. Your implied volatility can go to 2,000, 4,000, 8,000, 12,000, and this will just remain completely cooked on top, 100 all the way. So the way you read that is live on your options contract as you trade it. Because you'll start noticing that your IV is going to start dropping like crazy, and you're going to notice that you're not, for some reason, at this point, it said that I was up $1,000, but now that I'm over here, for some reason, I'm only up $850. And now that I'm up over here, I'm up only $900. What is happening? I'm beyond the target where I was, and I'm lower than the money that I should be getting. Throw an A in the chat if you've ever experienced that, if you've traded options contract with me. Let me know. It's an unfortunate thing, an unfortunate truth. So it is important to look at several metrics or keep track of several metrics as you trade this, which makes it just a little more difficult, right? It's okay. It's just the thing is just like driving, right? You just keep an eye on things. But there was a reason why I pointed out these three targets, right? These three here as an area to take profit in. I meant what I said, that we could probably reach up to $174 in one day. I meant that. Because if you guys picked up position with me the prior day, we picked up position, and this is where the scalpers class really comes in. We picked up position at around 137 to 139, 140s. The major entries here, guys, were of course 149 and 146, which some newer people that came into the trade late also ended up getting that benefit too. Now, when I came in and said, guys, let's pick up position, I picked up the position roughly around 139.98, 99, right around there, just about 140, and that I just waited, right? This was the day of earnings. This was also the prior day to our inflation read. And this was also the day that we said we would drop into this zone here. And why did we experience this drop? We experienced that drop because of the catalyst that happened that day. I think it was, what was it, a tariff or something that had, what was it, guys? On Thursday, something was announced and it capitulated the entire market. Do you guys remember what that was? Was it, I'm drawing a blank. The jobs report, that's right. Initial jobless claims and continuing jobless claims came in hotter than expected. We want this to deflate. So we got good news the prior day, right, about the jobs report. Somehow the numbers were looking good, but then on the actual read, the numbers were bad. So the whole market tanked. It took that value out, right? Coinbase reported quarterly lows the next day. That's right. So now imagine this. Let me go ahead and prep the chart again. Okay. Oh man, hold on, guys. Got it. Okay. Take a look at price here. Let's go to maybe the monthly too. Just so that we could see, right? Just where the play is. This is your monthly candle. It's real time, right? This is where it went. That day of the jobs. And I know that it doesn't take a neurosurgeon, right? It doesn't take a rocket scientist to understand that these are all confluent bottoms, right? So I want you to notice something. These are the things that I see right away. This bottom side, priced in at a low, of which you might not be able to see up here. the top left, the OHLC, open, high, low, close values. The low on that candle is 146.12. Now, the low on this candle, it's never, guys, it's close. It'll never be exactly the same. It's hard for it to be exactly the same. You're talking about nailing, you're talking about bullseye here from 1,000 feet, you know, or from like 17 miles away. Who knows? That's difficult, right? So this price here, from the low of this candle, 146.12. Now, September 3rd, 2024. Seven months later, the low of this candle comes in at 142.58. This is 146.12. So just like $4 less, right? Okay. Now the low of this candle came in at just about, it actually was in the after hours to 137, but in actual hours, this came down to what? 139. That's your 139.36. And this is just 142.58. Right? So it's like $3.50. It's around that $4 zone. Now, if we really start to pay attention, there is a possible regression happening here. I'm going to do this real fast. Hold on. I'm going to remove everything and undo everything at the same time. From here down to this candle here, there would be some type of regression, right? So if we put this like this, just around like this, your bottom side comes out to be around 138.21. Can we kind of manage this a little more? Yeah, well, let's not make that a coloring, but a crayon, and get this to be tighter. So if we get it to be tighter and get outside and really meet that actual regression, then your downside target here is what? 137.56, right? Let's put a line there with perfect regression. Let's go ahead and take a look at the 12-hour time frame, right? And see if we can't get that line to show us where price went to. So here, the low came in to just around, what the heck, all the way to 134. So in my perspective, do we have adjustment to make? Well, it looks like we kind of do, right? So I'm thinking we could reach 137.60, which is why you have my target. In a complete discretion, right? In this case, this is suggesting that we could reach a target of around 128.45. I got to stop doing this. Hold on. The targets that we were just talking about are all here for the play. Your regression, right? Potential 137s. The target to the downside could be observed all the way down to your area of 114, right? Which makes roughly this area here, the 50%-ish, right? Around these gaps. So that makes a 125 to just around a 128.63. So these targets were already shown to us. But that's not what people are really trading, right? I'm giving you the tiny, tiny targets. And you're thinking, ARCa, you're giving us entry. Like, hold on. This is what I'm trying to tell you. It's like, ARCa, you're giving it, like, you're not really being precise here. You're giving us targets from $128 to $149. Why? Because the move for this type of support is a move from roughly here to $450+. So there's variable or variance within a target that's $400+ away from us to a precise entry can only be done through zones, We're not going to nail the exact bottom because there's a random walk when it comes to volume. We don't know when somebody's going to say, I'm going to buy 4 million shares right here because his left butt cheek itched. We don't know. We never know that. So there's true chaos within the trade. But we have to understand how to price in psychology against probability too. And psychology being, is there a trend line like that angled one that I just showed you? Is there an area to stop price action from continuing to the downside here via any means at all? Could there be something like this here? Could there be something that rhymes with this one here, maybe over here? How many times do we have that rhyme happening? Does it have rhyming on a 5-day time frame too? There's that one candle. It appears to be near this one here and whatever else, right? We find it and we find it and we find the confluence of every single pivotal point and find the weight of it. Sorry, brother. What was it? I don't know. I don't understand the left or the right. Sorry. And then also, I don't know if it was for me. But you okay? Okay, team. The left butt cheek was the right one. Now, you have ARCa telling you. You have ARCa telling you, okay, guys, I'm going in here in these targets, right? And then I start getting all, guys, listen. I start getting all of the DMs. I start getting the text messages from people who are close to me. You know, earnings are today, right? You know that the CPI is tomorrow. We got to watch CPI. We got the interest rate coming in. Jobs report is bad. You know, bro, are you sure? We're getting it all, right? But ARCa still goes ahead and tells you, guys, I'm going in here. In this case, that's because I just simply don't give a shit. You know what I mean? I really don't care. So I'm going to tell you what I feel is going to be an area to highly likely purchase because the play may be inverted psychologically because everybody at this point, since we've been dropping and dropping and dropping and dropping as it goes day by day by day, there is something of a psychological component that is applied to a human brain called the gambler's fallacy. That once you win and you win again the next day and the next day, you expect it to continue repeating the same way. The moment it stops, that trend is what separates you from the regular trader and the regular person out there. How do we achieve that? Well, you have to think way ahead. You got to be sharp. You got to know your rules. In this case, we are looking at a pivotal moment that many people are not observing. Everybody's super bearish. At the point where you know this is going to fall to critical lows and all that good stuff, right? But the weight, I'm talking about the sheer weight, mass of volume that goes in these lows that we've seen already happen 3 times before. What is that weight? The first iteration around here takes you on a first ride that's 88.65% in its value. $150, just right around what? $150, right? To $284. You hear that? 120 points up. $120 move there. Now, the next time it happens, it really bounces, right? $4 down from that, for roughly $4 down, $5 down from that initial entry. This thing jumps to the upside here, making this a 140% gainer. From the bottom side of just about $146 to the top side of about $350. Then it happens again, and it looks like it's a pattern cyclically. Right? It looks like it has just a tiny or fair bit of increase as the iterations go. So we come at it again, and everybody is super bearish again. At this point, crypto sucks. Crypto is going to go to zero. Bitcoin is going to kill you. You don't know nothing, ARCa. You shut up. It's going to die, right? We're all going to die. This thing proceeds to make a 213-point move, which is equivalent to your target of just about what? $2 to $446. Increasing in value in like your service bars on your phone. Now, if this works this time around, like the times that it's worked before, because it kind of looks like we have a red bar followed by a gigantic green bar, right? It's red bar, green bar, red bar, green bar. It looks like we just did the same thing. We just red bar and green barred and closed the 5-day too, just like we did here and here. The weight of this makes me not care about what earnings is going to say, whether it's a miss or a beat. It makes me think that this is going to be such a huge move that they're going to invert the market quickly on the bears and take all that liquidity because of the expiry coming in on Friday, right? It's making me feel that I don't care about CPI or inflation at this point, but because we're at this support, I told you guys too that it's also making me feel, and we shouldn't bet or guess what the inflation is going to be, but I mentioned that this is signaling to me that we're actually going to have good news on the inflation. Whether it's neutral or good, those are interchangeable. So we did. And despite the miss on earnings, 6% miss, we got to move from an entry of around $139 to $168 today on that discretionary, really irresponsible decision. Do you understand what I mean? The psychological belief alone caused me to tell you that I don't care about anything else other than this is it. And I made sure that you guys knew that this is a call that is either make or break. But this is one of the most dangerous trades that we can take at inflection. And also at inflection is where you can find some of your most profitable trades. This was almost what I mentioned to you, a slam dunk trade if it works. Our first move on this, guys, our first from the beginning of a cycle that's probably going to repeat all over again, was telling you long BMNR 4 days ago, was telling you long coin, was telling you the bottom is in for XRP, for Ethereum, for BTC. We were talking about even through the means of Devil Dog, right? Saying even Wolf, right? That didn't do so good. It's just, and I mentioned to you as well that, you know, the Bitcoin miners for every cycle you're having, right? They're losing per transaction value, you know. So the miners are maybe not the best idea. I said, unfortunately, MSTR. I didn't even check it. But my focus, and also, guys, oh man, this is not a flex. Don't take it that way. This is not a flex. This is simply strategy, discretion. It's simply separating you from the trader that's next to you. Because both of you could be trading the same ticker, the same hour, the same strategy. It does not mean that your portfolios are going to look the same when that's done. One of you is going to win. One of you is going to really take it. But how do we react when things get weird, a little sideways, when things surpass our areas of entry? This is guys, short-term trading. This is the moment that you have to. Here, guys. Trading, especially short-term. I'm sorry to say, but you gotta love a loss. You gotta love it. Because that teaches you something. It teaches you not to do it that way next time. Rework it. Understand why it didn't work out. Understand why, right? And I gave a massive hint. On that XRP video to everybody. And that's not something I typically do. The XRP video from last night. I mentioned to everyone that the way that you can tell that this could be the bottom here for crypto in general is through your tier 1 broker, Coinbase. Massive holdings on BTC, massive holdings on Ethereum, massive participation and subscribers. Potentially the main one, potentially your number 1, tier 1 exchange is at demand. And it's at demand at max fear. You buy that fear, right? We buy that fear because we know that this has high probability to reverse on the expiry of those puts. We buy that fear because we've seen that this thing has the weight of 1,000% on the last observable iteration, and statistics show you that even if you have little iterations or very little count, right? Because we know that sample-based statistics are going to be valid when you reach many, many hundreds, many thousands of iterations repeated near the same value. But in observable iterations within relative time can be repeated with high probability. And we have 3. What makes you think we're not going to do it? The probabilities increase. It doesn't mean that they're not 100. It doesn't mean that they're 100%. It's just an edge. Then you tie it to everything else. There's a huge dead cat bounce on the 4-hour time frame, which is making me believe that they're setting a bear trap. Liquidity grab right below that, just like it did lower lows every single iteration from here. This one 164, right? This one right here, 147 or whatever that is. This one over here, 142. This one down here, 139. It's decreasing because it's liquidity grabbing every time. It's tricking you because you feel that it's about to drop. So the moment that it drops below the prior support, the liquid puts and short positions enter and literally surge in there to surge to short this thing to the ground. But the true players know and understand, guys, understand to their bone that this is the bear to bull handoff. So that is it for today's lecture, guys. Please let me know if this was something that you enjoyed. Should you need to sign up to the Scalpers Market, because this is the last public showing here, please reach out to me at arcabulls@gmail.com, guys. we're gonna go 14 weeks on this on the scalpers market, guys. I might even extend it. It might actually end up 16, 17 weeks, guys, without any cost to you. So just reach out to me, arcabulls@gmail.com, and we'll get this thing figured out, get you enrolled, and we'll be starting in private officially, guys, on Tuesday, 6:30 p.m. Pacific in the ARCu. And I'm sorry, next Tuesday, the following Tuesday. So there's not going to be any class this weekend in observation of your Valentine's Day and also the requests. I don't like to mess the hierarchy, right? And Coots, oh yeah, got you. Oh, perfect. Oh yeah. You know what? Let me just do the thing for you right now. I got you. You're an eternal now. Thank you so much. So yeah, guys, let me and you know what's crazy is that on the day after our entry, people were saying, "Oh my goodness, check it out. Coinbase is about to blah blah blah." Bro, we were already in. You're late. You're not thinking ahead, right? We got to be sharp. We got to be sharp. You got to be ahead of your normal intelligence. Right, guys? We have to be witty. You know, we have to find it, be kind of like a gerbil, right? We find the little holes and we get them, So it doesn't mean that any other strategy is wrong, guys. It's just finding a high probability trade like that. You even heard it from me 2 days prior. I was super excited. So excited. My demeanor changes when I find that play. I'm like, man, Robert Merkel. So Neo saying, by the way, Coinbase coin Zora at 2 cents, less than 100 million market cap. Whoa, micro. Other market data sources also show similar live pricing around the 0.219 USD per Zora token, with recent 24-hour trading activity and market stats varying slightly depending on the exchange and source for longer term hold. Yeah, so this is based on, Zora is an AI for Coinbase? Or Zora is an AI period that is also going to be used within the Coinbase platform. That's really cool. Ninja, thank you, buddy. Fern C, thank you, guys. Jay, thank you, brother. I love it, guys. You guys, you guys will understand. You guys will see. I'll release exactly what I do in those trades, right? I want to make sure that you guys see the value of it, right? To really understand what it takes to do day trading, right? Guys, it's just that. Man, I remember even, yeah. It's good stuff, team. And if you really think about it, it wasn't the overnight. If you really think about it, that play lasted just a couple hours. Coots, you're very welcome, and thank you. It is a Coinbase token. Got it. Used on their platform. Okay, got it. Oh man, the Zora. Got to check that out. And team, I know that a lot of you are probably going to be asleep or whatever, team, but I have to go to the store, pick some things up for my son, right? For how he's feeling. Then I'm going to come back and put him to bed. And I can come back live, guys, and do an XRP video with you and potentially market prep. It's whatever you guys want. You know what I mean? And so no class coming in the next couple of days, guys. That's what I'm saying. If we want to stay up late, do some charting or whatever, you can join me. Guardian, love you, buddy. Coots, thank you. Anything you need, guys. Any questions you have, I'm here. I'm at your service. Daniel, love you, buddy. Torito saying, if I'm awake, doubt it, but can you look at Amazon for mid-long? Yeah. You want to hold it? I mean, at these lows, of course, bro. There's many opportunities. No, I agree. Jay, thank you too, buddy. Ninja, have a great weekend. You as well, brother. And thank you. No problem, team. No problem. Let's be the best versions of ourselves, man. Yeah, brother, this was a fun class, man. It's probably turning out to be like strategies. Like it's helping you. It's like having you discover that short-term ability, that power. See you, Neo. You rest well. Thank you, my brother. Wesso. Oh, Wesso, dude, I love you, buddy. Thanks, man. Really appreciate that, brother. Of course. Okay, Mr. T, I'll see you soon, buddy. Whatever you guys need, guys, you reach out to me, okay? I'll take care of you. I got you. All right, guys, y'all be safe. If there are no more questions, let's go ahead and close up the shop, and I'll be back here a little bit later. I love you, Gar. All right, team. Thank you, everybody. Happy Valentine's Day. That's right. All right, guys. Take care, team. I'll catch you later. We'll speak soon. Later, guys.